Hi everyone, hope you're doing well. I wanted to lead this recorded lecture. This is for Chapter 14 related to accounts payable and other liabilities. As you remember, we're working through the stages of the audit. We're working through that six-step process and applying these kind of middle three, I guess, even though there's not technically a middle if you have six, but um, these three steps as it relates to each of the different transaction cycles. So just like what we did for much of the last section of the course, we're going to continue that on. Now we're moving to the liability side. If you kind of noticed, we did the asset side of the balance sheet before. Now we're starting on the liabilities. And today will be kind of the current or short-term liabilities. So there's our learning objectives with the with the priorities listed, similar to the other chapters where we're assuming that you already kind of know a lot of the nature of these accounts. That's why those are low. And then kind of the meat for us is understanding the objectives, the audit objectives, understanding the basically the audit risk model, and looking at inherent risk and detection risk as far as the main portion of our in terms of the high priority. The medium priorities are around the controls and the control risk. So again, kind of using this audit risk model as our framework for going through the chapter. First one really is about the nature of accounts payable and of the liabilities. And so this is something you already kind of know. These are these short-term debts, usually arising from purchasing goods and services. So you're acquiring inventory either to use in a manufacturing process or acquiring inventory you're going to resell, or you're acquiring some services that you need as well that could also be part of the accounts payable process. And we're the evidence is essentially the invoices and statements from suppliers. And then note here, interest-bearing obligations aren't included in AP. They would be in another liability account. So other accrued liabilities, right? Accounts payable is technically still accrued as well. But other accrued liabilities, these would include salaries, interest expense, rent. And so these obviously require estimates as far as their cash flow is different from their cash flow date is different from their recognition date, right? So we have employees that are incurring salaries over time. We're going to recognize that liability and the related expenses as they're being incurred rather than actually when we actually pay them. And we'll talk about those a little bit more at the end. So journal entries, this should be a review. You can think about what are the journal entries related to accounts payable. If you want to pause, feel free to pause it and just refresh your memory. But accounts payable is fairly straightforward. We have now this does depend on the kind of inventory method you're using. If you're using a perpetual inventory method, you're going to put the debit for the acquisition to raw materials or inventory, depending on if you're manufacturing or like a retailer. And you're going to, sorry, I'm trying to move this. You're going to use purchases if it's a periodic, right? So that's a periodic. Ooh, wow. That's some bad writing, eh? Periodic, and let's just call this perpetual. PER for perpetual. All right, so depending on which of those methods the client is using, that's how they're going to do the journal entries. Then to pay it, they're just going to do accounts payable, and if there is a purchase discount, then they would just reduce the amount of cash they're going to pay based on that purchase discount. But notice we're not taking the purchase discount up here, right? We're going to set ourselves up for the full amount of the amount ordered and received. But only once we pay it. If we pay it in early enough time based on the payment terms, then that's when we can recognize the discount. All right, so looking at the next learning objective, basically understand the audit objectives for how those assertions that are at the financial statement level, how are they implemented for this transaction cycle, right? So we still have our 6 assertions, but then how can we translate that into audit objectives? So the first one would be around substantiating the existence of accounts payable and making sure those purchase transactions actually occurred. The next is establishing that the recorded accounts payable is complete, right? There aren't any missing liabilities that the client hasn't recorded. And this is actually the primary assertion for accounts payable, because that's usually what managers are incentivized to do, right? Is to lower the amount of liabilities they record. The next is cutoff, making sure they're in the proper period. Then establishing proper valuation of accounts payable on the balance sheet, and then accuracy of the actual transactions. And then substantiating there is an obligation to pay, and also making sure that presentation and disclosure is appropriate. So for example, one of the disclosures for accounts payable is firms have to list if they have major suppliers that are supplying, a large portion of their purchases, because they could represent a risk to the firm. And this just is basically what I said in terms of primary focus is about existence, because understatement is the area we're worried about. So anytime you have understatement as a concern, then that means you're worried about, sorry, I said existence, I meant completeness. So understatement means you're worried about completeness. Did you put everything in there that's supposed to be in there, or is it missing something? If your primary concern is overstatement, then you're focused on existence. So is that excess amount, does that actually exist? So our next learning objective is basically dealing with inherent risk. And they have that under learning objective 4. We're going to use basically understanding of the company and understanding of this external environment to basically come up with inherent risks. So you're going to try and think about specific risks related to the transaction cycle, significant suppliers, contract terms, transaction cycle knowledge, which is essentially part of our learning objective 3, but understanding the transaction cycle is important for understanding inherent risk. And then including any fraud risk would be part of this step. And then understanding, for example, how intense is the competition, right? So how much pressure is on the firm to where you're worried about the firm not being able to meet its goals or objectives, to where then they're going to be tempted to misstate the financial statements. Also regulators, if there's a significant amount of oversight from the regulators, or if they're under very complex regulations, that could also be a factor. But a lot of the inherent risk stuff is done at the company level, even though some of it is specific to the transaction cycle. A lot of it can be at the company level as well. And so just again, as a part of that is gaining an understanding of the transaction cycle. We're going to do that by interviewing the client personnel, looking at their documentation around the account payable transaction cycle, and then looking at flowcharts as well. That'd be is just an example of a flowchart, right? Notice they have stores, which is where they're basically keeping the inventory, and the inventory is released from there. And so if that's getting low, then they're starting the purchase requisition process. Purchasing is essentially doing the purchase order. Receiving receives the goods, and accounts payable sets up the invoice, and that's on the purchases side. Obviously there's a cash disbursement side too, but we talked about that a little bit with the cash topic from before. And so then moving on to the next learning objective slash component of the audit risk model is control risk. So understand internal controls. Part of 3 is about identifying those as controls. Basically there you're thinking about, this is just as a student, understand the controls, and then objective 5 is the auditor obtaining understanding. And some of the key pieces there is just obviously segregation of duties matters in every situation we have. purchasing and cash disbursements is important there, because purchases is kind of the authorization of acquiring the goods, and disbursements is basically, who actually is writing the checks or authorizing, or excuse me, sending the payment. We don't want those two to be together. Um, Making sure purchase orders are approved, making sure there's good documentation controls, so the fact that they're pre-numbered, the purchase orders and receiving reports. Um, so in your AIS class, hopefully you talked about the three-way match, right? That was looking at a purchase order, vendor invoice, and then a receiving report, right? Matching up those three. That's one of the best controls here. It's an independent verification. Because essentially what that does is we take the invoice, and on the invoice we have quantity of what was ordered times price, right? And so we can verify the quantity based on the receiving report, and then we can verify the price based on the purchase order, because the purchase order should have the expected price the vendor's going to charge us. And so we have that independent verification being done of the invoice before we go and set up the account payable for that transaction. That's a really important one. I'm not going to go through each one of these, but the fact that we do bank recs, right, that helps reconcile cash disbursements. We can look at the vendor statements, the firm can look at the vendor statements and make sure it matches their subsidiary accounts payable account, right, that the client thinks that they owe the vendor. And so those are a few of the controls that are over the acquisition cycle. All right, so I'll stop here. We're getting a little bit high on this number of minutes for this video, and then I'll pick up with the next learning objective.